Hey guys, it's Dan here. In today's video we will talk about why financial markets are so important, and in this video you will learn, well, the basic principles of financial markets, so how do they work, the 4 different types of financial markets, as well as the different purposes they serve. So let's get started, guys. So let's start with the basics first. What is a financial market? Well, a financial market is a marketplace to trade financial products. That sounds like a no-brainer if you want, but it's very important to understand it. First of all, what is a marketplace? Well, a marketplace is a place that facilitates smooth operations between the buyer and the seller. That's very important. And the second reason why marketplaces are super important is they are efficient, which means you will always have a great match between buyer and seller. They are transparent, you always know the price of the products you are buying, and they are secure, which means you are always getting what you paid for. Think about Airbnb or the App Store on your phone. What do they have in common? Well, first of all, they are efficient. Airbnb, for example, brings someone who wants to rent his place to someone who needs a place. Second of all, it's very transparent. As you can see on Airbnb, you know exactly how much each listing is going to cost you and the fees and all these things. And they are secure because, well, first of all, the payment, for example, on Airbnb is secured, and you also get what you paid for, usually. So this is very important to understand the concept of marketplace. And then on this marketplace, you trade financial products. I will explain later what kind of financial products when I'm gonna talk about the 4 different types of financial markets. So the first type of financial market is the most famous, which is the stock market. Everybody has heard it. What is it exactly? Well, the stock market is a financial market for stock trading. By the way, stocks are the same as equity, are the same as shares, just for you to know. If you probably sometimes you hear share trading, stock trading, equity trading, it's all the same. What does it mean exactly when you're buying a stock? It means you are owning a part of a company. I'll give you an example. If I buy a stock or a share or equity from Amazon, I'm gonna be a part owner of a little tiny piece of Amazon. This simple as it works. Why is it so important, this kind of market? Well, because from the seller side, so from the company's perspective, companies sell their stocks to get cash. Think about it. If you are a company, you always need cash to grow. And the easiest way or the best way you can do it is just to go public, which means you go listed on a stock exchange here. So you have easy access to capital by selling your shares. Let's say if I have a big project coming and I need a lot of cash to finance my future growth of my company, I'm gonna sell some shares to get cash to finance my growth. On the other side, on the buy side, if you want, you have a lot of different types of investors who buy stocks for future returns. They're expecting or they hope that the stock price will increase and that they will get dividends, which are parts of the profits that are distributed. The last thing I wanted to mention about the stock market, which is pretty important, is it's a highly regulated market, which means that not every company can easily have access to it. It's pretty complicated to have access to the stock market, but once you get access, so once you are allowed to be on, for example, the New York Stock Exchange, which is the biggest stock market in the world, well, once you have access, you become a publicly traded company, which is the same as a listed company. Think about Apple, Google, Facebook, all these big companies which are listed companies. And what you have to know as well is when somebody talks about a private company like Airbnb, it means that this company is not yet listed. So you cannot buy it on the stock exchange because right now it belongs to private investors. Financial market is the bond market, which is also called the fixed income market. You will understand in a second why it's also called the fixed income. In this case, this financial market is to trade bonds. What are bonds? If you're buying a bond, It means you are lending money to a company or a public institution. A public institution can be the country, the United States, for example. It can be the city, New York City, for example. It can be a state, New York State, for example. So all these kind of different public institutions. So what's the goal of a bond? Why is a company issuing a bond? Well, a company issues a bond because the company needs cash for a project. It's a bit like the same as with the stock exchange before, where the company is selling their stocks to get some cash. But in this case, they are not going to a bank to ask for a loan, but they're asking the market to lend them money in exchange for an interest rate. Let me give you an example you will understand. On the other side, obviously, so the company issues a bond, and the bond investor who buys a bond receives fixed interest. Let me give you an example, it's gonna make a lot of sense. Let's say here you have the company, and on the other side you have the bond investor. Now the company needs some money, and they say, okay, we don't want to use bank loan, but we want to ask the market because we have more flexibility and higher volume. Maybe usually you use a bond for like $1 billion or something like that, very high debt amount. So in this case, let's imagine the company issues a bond, and one bond is $1,000 and interest rate is 5%. They find a bond investor who is interested in buying the company's bond at the 5% interest rate. So this is what happens. Once both agree, the bond investor will lend $1,000 to the company. So the company at the beginning of the process will get the $1,000, so they will have the cash. Now what is happening? Same as when you are asking your bank for a loan, it's not coming for free. Obviously you will have to pay interest. That's exactly what is happening in a bond as well. So the company will pay a monthly or a yearly interest. In this case it's $50, so 5% of 1,000, that's $50 per year to the bond investor. Let's say it's 10 years, for example. And at the end of the 10 years, so once that the bond investor got 10 times the $50 interest, the company will also pay back the entire sum which has been lended at the beginning. So this is how it works. And now you also know why it's called fixed income, because at the beginning of the process, the bond investor know that he will receive a fixed income, which is the interest of $50 per year in advance. So he knows that for, let's say, for 10 years. So why is the bond market so important? Because it's a second way of getting money and not asking a bank, for example. You don't have to go into the bank loan application process. In this case, you are asking the financial market, in this case, the bond market, to lend you some money and you give them some interest. This is how it works. Financial market number 3 on the list is the foreign exchange market, short Forex. So what is it? It's a financial market to trade currencies. The main currencies, you all know them, are US dollars, euro, British pound, Swiss franc and Japanese yen. So why do we have to do all that? Well, the thing is, a lot of goods internationally are only sold in US dollars. For example, if you want to buy fuel or oil, you have to buy it in US dollars. So I give you an example here and you will understand why this market is so important. Imagine a French airline which buys fuel to run their jets. This is how it works. The French airline, they have euros because they are in Europe, and the fuel they want to buy is, they can only buy it if they have US dollars. So simplified, this is what happens. Imagine this is my French airline, there's gonna be some intermediate bank, and there's gonna be the oil company who sells the oil, the fuel for the jets. So the idea is that the French airline, which has euros, needs to pay US dollars to an oil company because the oil which is listed that you can buy is sold in US dollars. And once it has paid the oil in US dollars, it will get the fuel from the oil company who wants US dollars. Now, here is the catch. Obviously, you see that there is some currency play here, otherwise it's not working. So what is happening actually behind the scenes is that the French airline who has euros need dollars. So what is happening? They're gonna sell euros to an intermediate bank, and this French airline gonna buy US dollars because this is what they want. So because they need US dollars to pay this oil company. So this sounds super complicated and everything. And in practice, it's pretty simple. If you let's imagine if you're selling. Let's imagine if you are sending euros and US dollars via PayPal, for example, or via your bank, you will see that the conversion rate takes place for you and there's nothing to do. But behind the scenes, actually, the bank, which is charging you fees for that, obviously, they will buy a currency and sell another one on this foreign exchange market. So this financial market here, the Forex market, is super important for all international trades, and that's why it's so big as well. So financial market number 4 is called derivatives market. So this one is a little bit more abstract, but don't worry, you will understand what I mean. So this is the market, that's the financial market to reduce risk. What does it mean? It means that on this kind of market, you're not buying an asset or debt, you're not buying shares, for example, of a company, and you're not buying bonds or debt, but you're buying the right or the obligation to do something in the future. Well, that sounds super complicated and abstract, but again, I'm going to give you an example very soon and you will understand that it's actually pretty simple. Imagine here you have an American airline and a fuel company. The American airline obviously needs to buy fuel for their jets, and the fuel company is selling fuel. Pretty straightforward. The goal here for the airline is to fix the fuel price for next year, because it's a big cost for them and they don't want this to be unknown. So they want to know how much they're going to pay next year for fuel. On the other side, the fuel company wants to sell their fuel at a fixed price known in advance next year, because they want to guess or have a good estimate of their revenues. So what is happening here? Let's imagine these two agree. They want to buy some fuel in the future and they want to sell some fuel in the future, and to do so they're going to sign a contract if they agree. So imagine it's going to be next year on June 1st, American Airlines will buy, fuel company will sell 100 barrels of fuel at $50 each. So as you can see, there is a duration inside, there is a quantity, and there is a price. And this is the kind of contract that you do on a derivatives market. This is kind of a derivative, for example. That's going to be a fuel future in this case. I don't want to be too specific about the products that are sold here, because I made 2 specific videos about it. One which is called how to reduce risk using hedging. That's the first video. I'm going to link it in the video description below. The second video, which is explaining the different derivatives, because it's a bit complicated. I made a separate video which gonna help you a lot if you want. What I also wanted to tell you, that this is probably the least famous market for you. You probably never heard of it, but it's the biggest one actually, because a lot of speculation happens here. It's not only a trade between 2 real companies, but a lot of traders use it to speculate. For example, you can also buy the rights to buy or sell stocks and bonds in the future. So that's why this one is super big. It has an economical importance, because obviously it can help both companies to reduce risk. But here again, there is a lot of speculation going on. That's why the market is absolutely huge. Okay, a little recap, guys, because we have seen a lot of stuff in this video. So as I mentioned earlier, we have 4 different types of financial markets: stock market, bond market, foreign exchange market, and derivatives market. Stock market is the marketplace where you buy and sell stocks. The bond market is where you buy and sell bonds, which are debt either of companies or of public institutions, like a country, for example. foreign exchange market is where you buy and sell currencies such as US dollars, euros, and so on. And the derivatives market, which is the biggest market when you look at the trading volumes, is the place where you buy and sell rights to reduce risks, also called hedging. So now my question to you, please answer in the comment section below. Are you investing in any kind of these markets? Do you own stocks, for example, or do you own bonds, or maybe do you trade currencies and these kind of things? I would love to know that. Let me know in the comment section below. Otherwise, I wanted to tell you that I post once a week, every Sunday. So if you like these kind of topics, corporate finance, market finance, you know where to find me. Don't forget to like, make sure to subscribe. I'm also on Instagram. If you Instagram me, Stan the Finance Man, you're gonna find me. See you soon, guys. Enjoy your week. Bye bye.